Hello and welcome to The Leap, Bank ABC's podcast. My name is Giyas Gokkent. I'm the Chief Economist for Bank ABC. I'm joined today by my colleagues, Senior Economist Yusuf and Banco ABC's Chief Economist Daniel out of Sao Paulo, Brazil, as we reflect on the economic impact of a very tense and volatile year so far and try to uncover what challenges and opportunities lie on the horizon. So let's dive right in. With the Russia-Ukraine conflict entering its fifth year, the Gaza conflict in its third year, and more recently the spread of tensions in the Caribbean and across the Middle East. These events have resulted in consecutive commodity price shocks and have deeply impacted trade and investment flows. The Suez Canal, for example, used to account for somewhere around 12 to 15% of global trade flows and about one-third of global container traffic. Unfortunately, container traffic is currently only about one-fifth of pre-conflict levels. And this situation has persisted since the end of 2023. Following the start of the US-Iran conflict more recently, maritime traffic through the Strait of Hormuz has slowed to a trickle. There used to be around 100 crude tankers that used to supply about one-fifth of the global oil and gas supply through the strait. Now, moving on to Yusuf, who will tell us about the effect of these geopolitical tensions on global supply chains. Welcome, Yusuf.
Thank you. Thank you for having me. Good afternoon. Prior to the conflict, there was about 20 million barrels of crude, condensates, petroleum products that was flowing through the strait. As you mentioned, that's about 20% of the global supply. Meanwhile, the disruption to gas flows, while a bit smaller, is just as significant. Almost 11 billion cubic feet of gas was flowing, mostly from Qatar, and that accounted for about 20% of the global LNG trade. And we're already seeing strains in sectors that are highly sensitive to energy prices. The surge in jet fuel has led to thousands of flights being canceled. There's already been one bankruptcy for a low-cost carrier in the US. Some countries, especially in Asia, have implemented policies to discourage driving and limit fuel purchases. And it's not just hydrocarbons that are being disrupted. Gulf countries produce between one-fourth and one-third of the world's key fertilizers. That's urea and ammonium phosphate. It produces about half of the world's sulfur that's used in agricultural production. And this is happening now during sowing season. Just to give you an example, the United Nations Food Agency is warning that about 45 million people are at risk of hunger because of the conflict's impact on fertilizers, lower yields, and higher food prices. The GCC is also a major supplier of inputs for pharmaceuticals, medical equipment like MRI machines, batteries, fuel cells, semiconductors. For example, chip manufacturing relies heavily on helium, of which 33% comes from the Gulf, and there isn't alternatives readily available for something like that. And this is having a real impact. The longer tensions persist, the more pronounced the impact will likely be. Daniel, if I could ask you, how has the conflict here in the Middle East affected you in your region?
Sure. Well, when you look at this, the impact in the Latin economies, I would say that it is also divided according to the relative importance of the oil sector in net terms. Basically, the net exporters are performing well vis-a-vis the net importers, and sectorally, basically the sectors that are most sensitive to increased oil prices, like transportation sectors, air transport, land transport, or even intermediates and chemical sectors have been the most negatively impacted by this event. And when we look in more broad terms related to the Caribbean situation and the Venezuelan issue, I believe it has basically muted effects both on global oil prices and the regional dynamics, because Venezuela in itself has a very huge potential of production of oil, but it does not exert this potential at full. In fact, the current production rate in Venezuela is running below 1 million barrels per day, which is 4 times below the average production here in Brazil, which is not a member of OPEC. In this sense, this is the main situation that we see here in Latam.
Perhaps, Yusuf, you can tell us a little bit about the OPEC angle, and UAE has recently left OPEC.
Yes, it's worth recalling that prior to the conflict, OPEC's policy was centered around a gradual and cautious loosening of its earlier production cuts, which was prioritizing, above all else, market stability. OPEC Plus is estimated to have a production capacity of about 50 million barrels per day, but in Q1, production was set to about 33 million. So they were producing about 2/3 of their maximum capacity. And most of this spare capacity was concentrated in the GCC. As you mentioned, the UAE leaving OPEC, the UAE has been investing heavily in its production capacity and likely felt constrained by these targets. For now, the decision to leave OPEC probably won't have an impact on prices. But once this conflict ends, when it ends, then we'll probably see this increased supply pressure oil prices.
Thank you very much for that, Yusuf. Indeed, because of the Middle East conflict, when we look at how much the Gulf producers have in terms of output 1 or 2 months into the conflict, after the start of the conflict, what we see is, at one extreme, in the case of Qatar, production of hydrocarbons is down to somewhere around 10 to 20% of pre-conflict levels. And on the other extreme, a country like Oman, which does not need the Straits of Hormuz to sell its oil and gas to its export markets in Asia and so on, is producing over 100% of pre-conflict levels and is benefiting from clearly higher prices. Other countries like Saudi Arabia, which typically exports about 1/10 of the global oil supply, they used to use the Strait of Hormuz for most of their exports. But because of the disruption, they've now diverted, the logistics towards the Red Sea, and they're using their pipeline, to export at around 70% pre-conflict levels. The UAE is doing something similar, exporting through the Fujairah pipeline, but only about half of what it used to export previously. So I think going forward, what we'll see is there'll be. And these are already happening, by the way. There will be steps taken by authorities in countries like Iraq, building a new pipeline towards Turkey to relieve the pressure, let's say, on the Strait of Hormuz. By Kuwait possibly joining another pipeline, perhaps towards the Red Sea. And UAE, building another pipeline, doubling its existing pipeline capacity to Fujairah. So these are all things that are ongoing, and I think we'll see probably countries like Syria, Turkey emerging as beneficiaries from these developments. So let me now turn a little bit to the global growth prospects as a result of these developments in geopolitics and the oil sector. And what we see there essentially is pre-conflict, we had a forecast of around 3.1% for global growth this year. This was roughly in line with the 3.2% growth in 2025. But following the conflict, we've marked down significantly our growth expectations. We think that now growth is going to be 2.9% or less this year, depending on how protracted the conflict is. And we could be looking at scenarios where we could see growth of less than even 2.5%. So what that would mean is there could be pockets of recession in a number of countries around the world. At the moment, what we see is, in terms of regions, relatively strong growth in the US. They're self-sufficient in a lot of commodities and so on, so they're benefiting from this. Europe, unfortunately, is suffering, so we see slower growth in Europe. We also see some growth impact in Asia. They're also dependent on energy imports and so on. And in the case of Middle East and North Africa, which is our region, we're looking at almost flat growth or even a small contraction possibly this year, and this is even in a relatively limited duration conflict, assuming that hostilities end by June. In the meantime, as I mentioned, because of higher energy prices, we're seeing higher inflation, and that too will have an impact on activity across the world, because interest rates will have to stay higher for longer. For the US, for example, a key market that we track, that we monitor, we've seen inflation rise from 2.4% in February to 3.8% in the April print. And we expect this to rise closer to 4% or higher in coming months because of energy price pressures and spillovers. So with that, let me pass the word to Yusuf, who can tell us what the monetary policy outlook is in the GCC. And perhaps before that, also touch on some of the other major central banks like ECB and the Bank of England, what they might do in the current inflationary environment.
Well, the ECB had lowered its policy rate to 2% back in June last year, with expectations that rates would remain unchanged in 2026. But with the headline inflation in the Eurozone already at 3% for April, the ECB will likely feel compelled to start hiking interest rates again this year. The same could be said about the Bank of England. Prior to the war, we had expected a rate cut or two, but the authorities over there are probably one or two bad inflation prints away from also considering a rate hiking cycle. And the GCC, they will follow the movements of the Fed. Due to their currency pegs to the US dollar, and even Kuwait pegged its dinar to a currency basket. It's still largely dollar denominated, so we do not expect them to deviate from the Fed again this year. In Turkey, the conflict has had a real impact on the disinflation process. Policy rate has been on hold at 37% since the beginning of the year, when we were expecting several rate cuts. And inflation has risen to over 32% in April. We believe the Central Bank of Turkey would probably want to remain on hold for as long as it can. But again, one or two bad inflation prints, and they would probably consider a temporary rate hike just to ease the pressure on the currency and protect its international reserve levels. Daniel, I wonder how the Central Bank of Brazil is responding to this conflict.
Here in Brazil, Yusuf, we are still on a process of calibration in monetary policy. Basically, we are reducing rates here in Brazil, but at a much slower pace than previously expected before the conflict. When we look at the growth perspectives here, we have in fact increased our forecast for GDP growth this year in Brazil. That also tends to pressure up inflation. And inflation in itself, it was forecast to run around 3.8 early in the year for 2026. And we also increased this forecast to around 4.9. Basically, we are talking of plus 1% increase in inflation expectations here in Brazil, and also an increased GDP growth perspective. These two elements still suggest that this calibration cycle will continue, but at a much slower pace than previously forecast. And we currently expect the base rate here in Brazil to reach 13.25% by year end in this context.
Thank you very much for that, Daniel. Brazil, because it comes under the commodity exporters that are not directly impacted by conflict category. Can you tell us about, in more detail, about the prospects for the economy, the growth, the external fiscal balances, and so on?
Perfect. I believe that one important thing to mention when we look regionally here in Latin, we also had this segmentation in terms of impacts. If I say like countries like Colombia, for example, they have a huge positive balance of exports of oil, around 4% of their GDP. They are also followed by Argentina with around 0.6%, and Brazil with around 1% of its GDP as a net oil exporter in these terms of relevance. On the other hand, we have countries like Paraguay and Chile that are net oil importers, and they are all being impacted according to this rule Their GDP growth revisions are obeying that. And in Brazil, in fact, we currently forecast a GDP rate of around 2% for this year, okay? Previously, before the conflict, we were talking of around 1.7% growth for this year. If you look at the current data, they already show that our balance of payment situation is improvement, and also our trade balance situation is improving a lot due to higher oil prices. And when we look at industrial production, one important element, we have here in Brazil what we saw the pre-salt basin, which is different. It's like oil coming from deep waters, and this pre-salt production has in fact increased since the onset of the crisis. Petrobras running rate of its capacity utilization is running close to 99% here in Brazil, almost full capacity of production of oil, and it also boosts activity and boosts, as you mentioned, external accounts. We have improved our forecasts around 0.2% for the current account deficit. We see smaller current account deficits for this year, around 2% of GDP. And on the other hand, when you look at fiscal accounts, we have like two dimensions to analyze here in Brazil. First, we have a first round effect that is positive for the tax collections, okay, that tends to increase tax collections with increased activity and increased exports of oil. On the other hand, the government has implemented several programs in order to cushion the impact of the shocks to the people. And in this sense, we have not altered our perspective for fiscal policy. It's still a perspective of a deficit in the primary concept here in Brazil.
Thank you very much for that, Daniel. Yusuf, in the Middle East, North Africa, of course, Libya and Algeria are important oil and gas exporters, which are not directly impacted by the conflict, but they are benefiting from higher energy prices. Can you tell us about their economies, how they're faring?
Yes, absolutely. Like you mentioned, they are placed far from the conflict. And this is going on while authorities in Libya have ambitious plans to raise oil production to 2 million barrels per day from about 1.4 million barrels today right now. We expect economic growth to be strong this year, somewhere around 7%. And next year, it will likely accelerate into the double digits. Higher oil prices will also support the country's fiscal accounts, will support external accounts, and of course, the exchange rate. And higher oil prices will also support international reserves, which are already at very formidable levels. The IMF last reported international reserves around 85 billion for March, which is about 54 months of import cover. And this will also support the country's rebuilding plans. It's a similar story for Algeria. Numerous countries have been turning to Algeria in search of new supply. We expect growth to accelerate by 4% this year. We also expect the budget deficit to shrink. We expect a current account surplus, that seems likely, which could ease pressure on international reserves, which had been falling prior to the conflict.
Can you tell us also a little bit about commodity exporters in Middle East, North Africa, but that are affected by the conflict in the GCC?
Well, maybe I could start with Oman. Oman is in a very strategic place. They don't rely on the strait to export. So they have been benefiting from higher oil production, as you mentioned earlier, while also benefiting from higher prices. We expect the economy to grow by about 3% this year. There will be an impact on the tourism sector, other non-oil sectors, but the rise in oil production and higher prices should offset all that. We also expect a budget surplus of around 5% of GDP this year. We expect the current account, a rather sizable current account surplus of around 8%, and we expect debt to shrink by that amount.
Kuwait, I think, had a significant decline in oil production, and likewise, I think Bahrain's oil production is affected. So tell us about their economies.
Bahrain was dragged into this conflict on slightly weaker footing. Growth was supposed to be doing relatively well. We've now revised our projection down to 1% contraction this year. The authorities here had made strides back in December to address its budget deficits and try to reduce its debt load. The conflict has since reversed those efforts. We now expect the budget deficit to widen by quite a bit, adding more to the debt pile. But having said that, we're not really concerned about Bahrain. there has been support from the GCC. It's already been forthcoming with a swap line with the Central Bank of the UAE, which has increased reserves and eased concerns. And more support would likely be forthcoming should it be required.
And you mentioned Kuwait?
Kuwait is a very wealthy country, so there's no pressure in terms of its balance sheet or reserves. Reportedly, oil production there has been lowered for just domestic consumption, so that we will probably see a very large contraction in growth. We will probably see budget deficits excluding investment income and current account deficits as well.
Let me now turn a little bit to some of the other countries in the Gulf that have been impacted by the conflict. Saudi Arabia, of course, had been pursuing these large development projects, diversification-related projects. And more recently, they had decided to recalibrate some of the scope of these projects. The conflict came in the midst of all of this, of course. But Saudi Arabia has been able to divert some of the exports away from the Strait of Hormuz to the Red Sea. So there has been some continuity in exports. And of course, the higher oil prices have offset some of the decline, let's say, from lower volumes. But nonetheless, from a headline growth perspective, we do see an impact. So we now have a growth forecast of around 2.7% for Saudi Arabia this year. Assuming that there is an agreement that ends these hostilities, we think that growth could easily rebound next year to 5.5% or perhaps higher. And finally, UAE, of course, has been affected by the conflict. We've shaved our growth forecast for the UAE from around 5% for this year prior to the conflict to around just under 1% after the conflict, assuming that it's a limited duration conflict. But the external and fiscal balances in the UAE are very strong. So we don't really see any negative spillovers that are going to persist. I think the one thing that needs to be mentioned, though, is a vulnerability in the real estate sector, because there had been a run-up in real estate prices in the UAE. So in the case of a protracted conflict scenario, I think there could be downside risks from the real estate sector. So let's finally try to wrap it up with a few words on commodity importers. I'll touch on Egypt and Tunisia. So Egypt, of course, had been reforming in recent years. They had faced a consecutive number of energy shocks and various conflicts and so on. More recently, I think they've allowed their exchange rate to become more flexible, and that has allowed the economy to absorb the shock. They were able to withstand the outflow of more than an estimated $10 billion in portfolio investment in recent months. And yet the economy has remained resilient. Growth is still expected to be around 5% in this fiscal year, and possibly accelerate to 5.4% in the next fiscal year. In the case of Tunisia is a commodity importer, so they're vulnerable to an oil price shock. We expect growth to be there around 2% this year. There is a widening in external and fiscal deficits, something that we're monitoring, but for now, they're withstanding the shock. So how about Jordan and Turkey, Yusuf?
Well, Turkey imports about 90% of its oil and about 98% of its natural gas. Not that much comes from the Middle East, but the higher prices have impacted the economy. We've revised our growth projections down to just over 3% this year. We now revised our current account deficit to just over 3%. The budget deficit will probably also grow because the authorities have to spend more. Authorities have also taken steps to limit the impact of higher oil prices on consumers at the fuel pump, but still, this will pressure household incomes, which reduces household consumption and squeeze weigh on one of the most important growth drivers. It's still in a very solid place, Turkey. We're not worried. It's just the year is not going to be as good as we initially thought.
To sum up, for this year, prior to the conflict, we had an oil price assumption for Brent crude of around $62 a barrel. We raised that to around $91 a barrel in this limited conflict scenario ending in June. In a more protracted conflict scenario, I think we're looking at potential for Brent crude to exceed $100 a barrel. and there are ramifications obviously for the world economy accordingly. I think this outcome for currencies will be a binary one. So if conflict is limited in duration, then I think you can see a sell-off for the dollar to some degree, so a reduction in risk aversion to the benefit of emerging market currencies and other major currencies. If, on the other hand, if there's protracted conflict, then I think you're looking at a scenario where the dollar will remain strong, and that will be to the detriment of emerging market currencies like the Egyptian pound, which has depreciated, as you know, in recent months. I think going forward, we're looking at a situation where there's a rise of a multipolar world order, and what that means, unfortunately, is geopolitical instability will be the norm rather than the exception, and that's something to keep in mind. There are two events in the near term that we're keeping an eye on. One of them is elections in Israel in October, and the other one is midterm elections, congressional elections in the US in November. So I think those will shape global developments, and of course in the meantime, we'll see how the Middle East conflict evolves and what the US administration decides to do in Cuba and so on. So with that, perhaps Daniel can give us more color in terms of developments there.
Sure, Giyas. Just like you mentioned, almost every asset pricer here in Latin America will remain highly correlated to the dynamics in oil prices. And when you look at the shape of the futures curve, it is still in a backwardation mode. It is pointing exactly towards this $91 per barrel on average in 2026, going down only smoothly and reaching around $75 per barrel only in late 2027. Basically, what the market prices are telling us is this perspective of a relatively short-lived conflict, which tends to be somehow resolved within the next quarters. And this perspective is what embraces us to expect also a good perspective for Brazilian assets in the medium term. It's important to mention that we are talking of real interest rates here in Brazil around 10%, even in the medium term, if all forecasts are confirmed, or forecasts both for the Selic rate and inflation in 2027, which is running slightly below 4%. And with that in mind, the perspective for the currency, given the fact that we are still a net oil exporter, is still a positive perspective for our currency. If we look at the dynamics of our forecasts, basically, we are expecting now a more appreciated level for the BRL vis-a-vis the expected before the conflict, basically because of these two reasons: the good and outstanding performance of our external sector driven by higher oil prices, and also the perspective for a more cautious decrease in interest rate than previously forecasted. Okay, we basically point at around 5.2 for year-end projections in this year for FX rate in Brazil. And with that, what is the perspective for your region, Yusuf? What do you think here?
Before we jump to the region, Daniel, can you tell us what you expect in the elections in Brazil? I think it's in October. Also what you mentioned that oil prices is benefiting the external and fiscal balances. Should we expect a rating upgrade, sovereign rating upgrade in Brazil?
Oh, perfect. Well, when we look at the perspective for the elections here in Brazil, we still see a very polarized event, just like what we saw in the latest two elections. Looking at the current state of information here, it suggests that Lula is slightly favored to win, okay? Basically, this is important because the markets and the economic agents know Lula's reaction function, okay? And we are not talking of any sort of disruption, be it in terms of monetary policy, fiscal policy, and exchange rate policy. Basically, we are talking of no change in regime here in Brazil. And on the other side, we have Flávio Bolsonaro, who is the son of former President Jair Bolsonaro, And he has presented himself as a more market-friendly name. That tends to give some upside in terms of market prices in the case if he, improves in polling numbers. He's currently running below Lula at the latest polls, okay? And in this sense, we see that, and we expect the impact of the elections in itself on asset prices will be basically neutral. Okay, it tends to increase volatility, especially during the electoral cycle in itself, which starts at the late of second quarter usually. Okay, it reaches its peak during the third quarter. And during the fourth quarter after the election, there's a tendency for asset prices to accommodate. Basically, we see neutral impact of elections. And in terms of fiscal and external accounts, when we sum up all of these together, it is still a perspective of gradual consolidation of fiscal accounts, and it will depend heavily on who wins and the policy of who wins next year, what the policy will be implemented in terms of containment of spending vis-a-vis increased tax collection. This is the main issue that all the rating agencies are monitoring here in Brazil. If we see the rating outlook of the three majors, they remain basically stable for Brazil. And we are running 2 notches below investment grade by S&P and Fitch. Only by Moody's we are 1 notch below investment grade, with no tendency of change until the next government assumes power here in Brazil, basically.
Thank you very much. Yusuf, can you tell us about elections in Turkey and the outlook for ratings?
Of course, the big question for Turkey is if President Erdogan will be allowed to run again under the current rules. He's technically not allowed to. Presidential elections are scheduled for May 2028, but there's growing rumors in the Turkish press that maybe snap elections or earlier elections will be called as a way for him to potentially run again. For ratings in MENA, the impact of the conflict has been relatively limited so far, but the longer this conflict goes on, the higher the probability that negative rating action will be taken, especially on the more vulnerable countries such as Bahrain due to widening budget deficits and growing debt. On the other side, although we don't expect rating agencies to upgrade during a conflict, the MENA country most likely to see an upgrade is probably Oman. We mentioned earlier stronger growth, budget surpluses, lower debt, external surpluses, so they'll probably come out of this with something in their ratings to show for it.
Thank you very much, Yusuf, for that perspective. And thank you, Daniel, for joining us in this morning in Brazil, our afternoon. And we hope that our viewers found it interesting. We look forward to another discussion in the future with you. And in the meantime, take good care.